How are you doing, people? Troy here with the Bet Out of That show. We'll be dealing with betting on yourself and getting you on the road to financial freedom. Come here for topics on health, wealth, finance, and self. I'll be having guests from a range of fields to empower you on this journey with me. Make sure you like, comment, and subscribe to the Bet Out of That show.
Cash move everything around me. Bet I'm surrounded by sharks, so try not to get wet. Your finances are gone, the more you are a threat. The more money you get, the more you should invest. I'm black on my neck, back on my shift. Back on my grind till the sun start to eclipse. Credit score check, debit amount check. High risk success, bet I'm out of debt.
Economic data is easiest to analyze after the fact, but a little digging can shed insight on where things stand and what sectors offer investment opportunities even in the midst of hard times. Here's a list of the 4 basic stages of the economic cycle and some telltale signs associated with each. An economy in full recession has seen its gross domestic product retract over 2 consecutive quarters. Interest rates fall and consumer expectations bottom out, while the yield curve remains normal. Economic sectors that usually profit most during recession include cyclical and transport industries near the beginning of the stage, plus technology and industrials near its end. In the early recovery stage, the economy begins to pick up. Consumer expectations rise and industrial production increases. Interest rates bottom out and the yield curve starts to get steeper as well. Sectors that are successful in this portion of the cycle include industrials during the beginning, basic materials, and energy near the end. In the late recovery stage, interest rates rise and the yield curve flattens. Consumer expectations drop and industrial production is flat. Sectors that succeed typically include energy near the beginning, staples and services near the end. And in the early recession stage, consumer expectations are at their lowest. Industrial production falls, interest rates reach their highest, and the yield curve flattens or inverts. Sectors that do well in the early recession stage are usually services near the beginning, utilities, cyclicals, and transports near the end.
So, Patrick, welcome to the building. Good morning.
Hi, good morning, Troy. How are you doing today?
I'm doing good.
Sunday afternoon, Sunday morning.
Exactly. Now, look, Patrick, we just saw an economic cycle. Where are we in the economic cycle, my friend?
Okay, so right now, I would suggest that we're pretty much at the top of the economic cycle to starting to fall a little bit. So we're probably getting closer to the decline stage where we would possibly get into a recession sometime later this year or the next year.
So why is this whole economic cycle talk so important for our newer and younger investors? What's the message here, Mr. Dougherty?
Well, you need to understand where you are in the economic cycle so that you can, first of all, plan accordingly, so that you could, if things are going to be a little bit tougher, it may be harder to save money, harder to earn money, you want to be able to budget yourself through the tougher, slower, perhaps recessionary and contractionary period, and then you'll be able to weather that storm more than most people who don't plan.
Right. And, for a lot of investors, they see all of these news clippings and reports on CNN and even your CNBC, Bloomberg's, and financial channels or Fox financial channels. And they always talk about the gloom and the doom and all of the bad economic conditions because that gets views. But I guess the real point here is this is just normal cycles. Economy goes into an inflationary period, a deflationary period, and depending on where you are in the cycle, it is proven that certain sectors work. You know what I mean, Patrick?
Exactly. There's certain sectors that do better than others in a declining economy, and then you'll have a completely different set of sectors that do well in an improving economy.
So do not panic if your retirement account is down as much as mine. or some of your other discretionary stocks that you hold. It's just part of the normal conditions of the market. So just don't panic, all right? And that's the big point. So, Patrick, how do we know if we are in an economic downturn? How do we know where we are? How do we know where we are in the cycle?
Okay, so you will probably hear a lot of the headline noises that, maybe the various economic indicators point to a slower economy. You might get maybe a GDP number, a gross domestic product number that measures economic growth, slightly lower than, or gradually becoming lower and lower as the months go by. And then that would suggest that we're probably going into recession, or the employment numbers start to tick up. Business investment might be shrinking. People might be saving more, things of that nature. There's less economic activity in the economy, and the economic numbers reflect that.
So, Patrick, if inflation is really the key to this whole economic cycle, controlling inflation, right? How do I know I'm in inflation? What is the measure of inflation so that we can go to that segment? Because that's really where we're going here in this discussion. So
Exactly. So when you have a period of higher inflation, you would look at a measure called the Consumer Price Index, or CPI for short, and it's produced by the U.S. Bureau of Labor Statistics. So if we're in a higher inflation, then the CPI number, based on a percentage, would be elevated. The Federal Reserve would like to keep the ideal inflation rate at 2%, and this is basically the cost of a basket of goods. We'll get into that later. As a percentage increase over time, so there'll be some kind of base year, and then each successive year that we were in, or successive quarter that we're in, it was a measure as a percentage of price increases based on the price level of that base year.
wow. Patrick, that was a mouthful, and I think everyone that was viewing this live stream right now just cut out. Let me play a video on the CPI. And Patrick, you are a corporate tax attorney, and you've been in the market for decades. And so I don't want to completely lose our viewers on the CPI. That was an excellent technical response. But let me play this video from Investopedia on what the CPI is.
The Consumer Price Index, or CPI, is considered the benchmark inflation guide for the U.S. economy. It uses a basket of goods approach that aims to compare a consistent base of products from year to year, focusing on products that are bought and used by consumers daily. The price of your milk, eggs, toothpaste, and haircut are all captured in the CPI. The CPI is calculated by taking price changes for each item in the preset basket of goods and averaging them, with the goods being weighted according to their importance. The index uses a base year for comparability of its calculations, so changes will often be provided on a percentage basis to reflect only changes to prior index levels. There are two CPI figures, the CPI for urban wage earners and clerical workers, the CPIW, and the CPI for all urban consumers, the CPI-U. The most watched metric is the CPI-U, which is often presented with a seasonal adjustment, as consumer patterns vary depending on the time of year. The CPI is a detailed release with breakouts for most major consumer groups and geographical regions. The CPI is also used to identify periods of inflation or deflation. Large rises in CPI during a short stretch typically signal periods of inflation, and large drops in CPI during a short period usually mark periods of deflation. As well, the CPI is used to make changes to cash flow mechanisms such as pensions, Medicare, and cost of living adjustments. The This versatility means the CPI affects nearly every market and person in America.
So if we were in the economic cycle, the video that we first showed in the beginning, first we need to determine where we are in the economic cycle, number one. And the CPI helps us determine where we are in the economic cycle. Is that correct, Patrick?
It does. It's one of the major contributors of the predicting where we are in the economic cycle.
Right. And so all of this talk related to inflation and all of that, one needs to know, one, the CPI and where we are on the economic cycle. Two, once we know where we are in the economic cycle, then we know what baskets, sectors or stocks to invest in, because based on that cycle, certain stocks work, certain stocks do not work. Now, Patrick, what is your strategy for that? For me, I do not try to time the economic cycle because it's just too difficult. You know, I have a job, I have businesses, I rent a property, I have a life. So it's just, I'm not going to try to time the economic cycle. And there's another way to make money without doing that. And that's just being a long-term investor and invest in certain sectors. For me, it's the technology sector. I know it's going to go down in particular periods of the economic cycle. So I buy when the economic cycle is at a period where tech stocks are low and cheap. And then when it goes up, then I have the option to sell if I need the money. But if I don't need the money, I'll just ride it out, because over time it continues to go up over a period of time. And, you know, you make money over time and you do not have to time this cycle. That's more trading, if you will. And so if I know I don't need the money for 5 years or 3 years, I'll just ride out the economic cycle. But for a trader, that economic cycle is extremely important, because they're looking at the cycles, they're trying to get in, get out, and time the market. What are your thoughts on that?
Exactly. Well, my thought would be to have a fully diversified portfolio, not just tech, but you want to take a look at some financials, maybe some defense stocks, especially now with this war in Ukraine. You want to take a look, you want to buy some of the best healthcare stocks, because in times of inflation, healthcare costs rise. So essentially, you want to have the best of breed of all industries.
All sectors,
And
so that you're making money at every stage of the economic cycle. I hear you,
for
Patrick.
for example, you know, some of the high-tech stocks that we like to invest in, such as the NVIDIA and AMDs, they're at 52-week lows.
Right.
But conversely, healthcare stocks such as Humana and Eli Lilly, especially Eli Lilly, one of my bigger holdings, that has reached an all-time high.
So what are you doing, Patrick? Are you going to try to sell on the economic cycle and be a swing trader? Or are you going to hold on to it? And are you loading up on the tech while the tech is down?
Well, what I'm doing right now is kind of holding the healthcare stock that have the Eli Lilly, and as the market is bottoming out right now, I am slowly but surely buying some of the tech stocks, but it's tech stocks that have been proven winners. Because again, in this inflationary environment, you do not want to buy stock in companies that don't have earnings.
Right. But here's the key, Patrick. We keep saying this weekly. Don't panic. It's just an economic cycle. So stocks that are down, and if you're way down on your account, it's going to come back if you got proven companies that's making money and growing, because that's how stock prices grow. They grow based on profit growth over time. So within a particular economic cycle, the market would pay more for a forward PE or a PE ratio, more in different sectors, I would say different phases of the economic cycle. So when the market is willing to pay a higher price to earnings based on where you are in the economic cycle, stocks are going to go up if they're making money and they're solid companies. So that's why we focus on the fundamentals a lot in past shows. If you look at some of the past shows that we just did over May and June, you would see us talking about, Patrick, you remember what we were talking about there? About, are we at the bottom, the fundamentals, the forward
Yes.
PE, the growth rate, how to use Yahoo Finance and all of that. That's why that's so important, because stocks are going to go down during certain periods because of the economic cycle. The point is, will it go up once it turns around? And that's based on the fundamental stuff that we were talking about in May and June. So, Patrick, let's go into key takeaways for the CPI, because the CPI numbers will be coming out. They come out monthly, right? And you will see those in all of the financial shows like CNBC and Bloomberg and all of that. And some people do not pay attention to that CPI, but that CPI is what the Federal Reserve, Jerome Powell, is doing to control the economic cycle that we opened the show on. And so, knowing the importance of that, let's go over some of the key takeaways of the CPI, because I think we just explained ad nauseum why the CPI is important. So, Patrick, here is the screen.
Yes.
Here's some of the takeaways. What are some of the key takeaways on the CPI here, my friend?
Okay, so it's mostly widely used. It's the most widely used measure of inflation, and it's followed closely by policymakers, financial markets, business, and consumers. And it's the overall change in price, or based on a representative basket of goods and services. The widely quoted CPI is based on an index covering 93% of the U.S. population, while a related index covering wage earners and clerical workers is used for cost of living adjustments to federal benefits. So that latter part, that's the CPIW, is more for the governmental use. CPI is based on about 94,000 price quotes collected monthly from some 23,000 retail and service establishments, as well as 43,000 housing rental units. So it's very representative of the entire U.S. economy, or any economy that you're measuring goods and services for. And housing rents are used to estimate changes in shelter costs, including owner-occupied housing that accounts for nearly half of the CPI.
Nearly a third.
Or sorry, a third of the CPI. Sorry,
Yeah,
my mistake.
so a third of the CPI number that measures inflation comes from, housing costs. So, Patrick, people can go to Investopedia to learn more. We put this stuff out here so people will know how to fish for themselves. We're certainly not trying to be the experts in all of finance. There's much smarter and established people out there. Certainly, this is some of the things that we use that works for us. Patrick, just some of the things to zero in on is the CPIU.
Yes.
So
yes,
and
yeah,
go ahead, please.
So as I was discussing earlier, the CPI index for all urban consumers, CPIU, is what most financial gurus on any of these shows, CNBC and so on, would focus on. And that represents 93% of the U.S. population not living in rural areas. It doesn't cover spending by people living in farmlands, institutions, or on military bases. But the CPIU is the basis of the widely reported CPI numbers that matter to financial markets. So the numbers that you will see on a monthly basis, and they'll come out sometime next week.
Yeah, so Patrick, just to keep it succinct, so that's the CPIU is the number that we often see reported. The CPIW, as you said earlier, is used for government workers and to adjust for costs of inflation, COLA, in the government sector.
So yeah, that's more internal. That's more for government use. That
And
number.
then I just wanted to show this to our audience because it's important where those inflationary numbers are coming from for the CPI. So
Yes.
you can see that these are the 8 categories for the CPI, right? So and let's go back here. Sorry, blew that up a bit.
That's
So
okay.
yep. So you got
So
housing,
with
apparel, and
how,
company.
transportation, education, and communications, uh,
Patrick, they can see
recreation.
that. We don't have to read all of that, but yeah, you can see that's where the CPI number comes from, my friend. So
Yes.
basically, what did we said in a nutshell today, Patrick? We said what? The economic cycle, the normal. We keep preaching the same thing. Do not panic.
Exactly.
Just buy solid companies. And I like what you said, Patrick, about diversity, right? If you diversify in different sectors, I highly concentrate in the tech sector. I used to be more diversified, and all of the gurus say diversify. But I like to play a particular sector, and when I need my money as economic conditions change, I can pull some out, I can leave it there. But I like technology because of the fundamentals, and I've been heavily weighted on the technology side. What you said is more prudent to be more balanced, and everyone says it, but I'm just going to be honest. I'm more on the tech side, my friends. So,
And to be quite honest myself, I am also focused on the tech side, especially the semiconductors.
exactly.
Those,
But the fundamentals are easy to follow, and the growth is there. So as you go through
yes.
economic conditions, you have growth almost guaranteed unless the leader leaves and
And
the technology goes outdated or a competitor takes them out. Those are some of the risks you have to deal with. But if you're investing in a company like Apple,
yes.
Nvidia, AMD, who took out Intel, you see? So you just still have to be on top of your economic news. But Patrick, let me say this. First of all, if you like what you're hearing and if you're getting some good value out of this content, like the video, share and subscribe. This is intended for our younger viewers and newer investors. So thank you very much for the support, and hopefully we're bringing value to you and you'll understand what we're talking about in this complicated investment game. Now, Patrick, next week I'm traveling to South Carolina for the company I work for. I'm going to South Carolina for business. I'll be out of town for a few weeks, so I'll be traveling next Sunday. But the following week, from the East Coast, from South Carolina, I'm going to have a guest on the show talking about saving money. We're going to do a bet out of debt. In other words, invest out of debt with dentistry. I have a guy that's coming on that saved a significant amount of money getting cosmetic surgery on his choppers, on his teeth. He went over to Colombia. He got quoted. He wanted to kind of brighten up his smile and make it kind of, Hollywood. So here in Seattle, he went to some dentistry places here, and they wanted to charge him $36,000 to put veneers over the front of his teeth. $1,800 per teeth. I think he did 10 up front, 10 below, which came out to 36. So he did some research, and he went to Colombia and got the dentistry work done. Patrick, you would not believe how much it costs to get that dentistry work. $36K in Bellevue, Washington, Seattle area. In Colombia, $7,000 out the door. And he's going to come on and talk about that experience. So I said, dude, you got to show me the before and after. And so he sent me the before and after, and he said he's willing to come on and share with the audience his experience going over to Colombia. Now, Patrick, what do you think of that?
Yes, I think it's definitely worth exploring because I know I'm in the midst of getting some dental work done myself,
What
and
are
I'm
you
trying to
looking?
save.
What are you looking to do, my friend? Because this right here is all it's gonna get. I'm stuck with this. So what are you gonna do?
I'm gonna try to get maybe some Invisalign so I can straighten the top and the bottom.
Okay, okay. And what are they quoting you in Los Angeles, California?
Yes, the dentist that I go to here in LA has quoted me $5,000
$5,000.
for the Invisalign treatment. Yes.
And so we'll ask our guest who's coming on 2 weeks from now what that would cost in Colombia. Probably in the hundreds, because going from 36K to 7K to do veneers. And I saw his veneers. You know how some people put those veneers on and they look like piano teeth? They're
Yeah, they
huge.
do.
You got the Tiger Woods, the Chris Rock look. I mean, they look ridiculously bad and crazy. Look like a big beaver.
Yeah.
Man,
I
his
mean,
stuff looks
I see
natural,
other.
dude. His stuff looks really, really good. But go ahead.
Yeah. No, I see all kinds of horrible work done in when in LA and Beverly Hills and Santa Monica, and
Yeah,
it's just ridiculous.
yeah. I think
And these
Colombia.
people and
Go
these
ahead.
people spent all this money, and they probably even look worse than they did before the operation.
Yeah, I think Colombia is known for being like the cosmetic, one of the cosmetic leaders in the world. But anyway, spent way enough time on that. He will be on, and he will be smiling with his pearly whites and taking questions from the chat. I will be promoting that show in probably a week or so. Let's go to the comment section. Let's go to the chat. Do we have any questions or comments in the chat? We have a few people in the building. Gail at Night, I'm a big fan of. And if Richard Mack, Zoom to Thailand, knew you were over here, Gail at Night, he would be jealous, but there's no need to be jealous. You're among friends over here. And for those who do not know Gail at Night, you got to go check out her show. Her show is pretty awesome. I've been watching some of her content. My moderator, please drop Gail at Night's channel. You guys need to subscribe to her. Check her out at the minimum. And she's the lead attorney's moderator. She's great. And so welcome. Thanks for coming over, Gail. And do we have any other comments? Because if you guys have comments or questions, I just want to make sure we cover those before we end the broadcast today. I do not see any additional. What is that? That is the average cost. I don't know what that average cost is. Were we talking about the dentistry stuff? I don't know.
I don't know. I guess we're talking about Invisalign or
Yeah,
whatever.
I got to the chat a little late. But Patrick, I mean, that's kind of what we wanted to share today. We wanted to keep the show simple. We wanted to
Yes.
keep the show short. We wanted to get to, things are turning. And Patrick, do you think we are at a bottom now? As far as the market, do you think the market is going to continue to just go up from here? And from here out, people can invest and continue to get profits? Or do you think the market's going to pour back? Or you just don't know and you want to push and not go on YouTube and give a response?
Well, I'm going to say that I don't know because right now this could be some kind of bear market rally, right? And right now there's no question that we are in a bear market. And the thing about bear markets is that any move up or downside is just so unpredictable. So you might get a CPI report that might hint at maybe more pain for stocks, but then the stock market could continue to rally as it has been for the last week or so. So we don't know. I can't say for sure, but in the long run, what you want to do is invest in the best of breed companies. I mean, we always preach that.
Yeah, Patrick, I think we're still in a bear market. I think the economic conditions are unusual. I think we're going to have a bear market bounce, and then we're going to fall again later on in the year. You
And that's
didn't
likely
you
the
didn't give a
case.
clear response on these YouTube streets. I'm willing to go on the record and be wrong if I'm wrong, and I'll be happy if I'm wrong, because I'll make a lot of money if I'm wrong. But honestly, I think this is a bear market bounce. I think the market is going to go up over the course of July, maybe. Earnings is going to come out. When earnings come out, because of economic conditions with inflation, with housing prices are way out of whack, employment not able to hire people, and employment wages so high, and technology has not caught up to replace those people, as well as the car shortages and used cars costing more than new cars. That's still there. We still have some economic situations where, all of this bounce and even stock prices looking low I think is going to continue to go down. I think it's going to go up a bit and it's going to fall down even further than where we were previously. So with that said, I hope I'm wrong, but the content that I've been putting out is saying my beliefs, and that is a bear market bounce. But that's kind of what it is. But Patrick, I think what we'll do is we will wrap it up. We will have our guests on in 2 weeks, so we will not be on that Sunday, but we'll be on the following Sunday. I will be in South Carolina, South Kakalaki, back on the East Coast where I'm from. Everyone knows I'm from Virginia, from the Norfolk, Virginia area in particular, so that's where you get this southern accent from. But I'm going to be excited to be back on the East Coast. I'm probably going to visit my parents while I'm there. And then we're going to bring on our guest, and he's just going to break it down, and we're going to show the videos of his Hollywood smile, and we'll see you guys then. So let me wrap up the show here, Patrick. We call this show the Bet Out of Debt Show because when you place a trade, it's called placing a bet, which is a metaphor for investing. And hopefully it's a winning one to keep you out of debt. And as always, keep investing. We're here on Sunday mornings, typically at 8:15 a.m. We had some technical difficulties this morning. We appreciate the support. We look forward to seeing you in 2 weeks. And hopefully you guys have a good weekend, and we'll see you next time.